Ladies and gentlemen, thank you very much for participating in the webinars and making this time in this beautiful sunny Silicon Valley day. The picture in the background is a picture of the Silicon Valley taken from the Rancho San Antonio Hills. And I always enjoy looking at that picture and share it with the people participating in our webinars, and basically count our blessing that we live in a great area, in a great neighborhood where it's a lot of opportunities that exist, and as well as a beautiful weather. So as far as the agenda for today's presentation, we'll spend about 5 minutes of talking about the general stuff a little bit. Then we'll go and making the case for investing in general. So this is about a 10-minute segment that discusses this notion of investing in general and why it is important, and so on and so forth. To some of us, it's obvious. To others, it's not. And I guess it's always surprised me when I spoke to my client that some of them are not very well prepared for that topic and the importance of that, beside hearing about it maybe. As far as the second, third item, we'll talk about real estate as an asset class, because not everyone is familiar. A lot of people are familiar with the stock, bonds, etc., but not necessarily with the real estate as an asset class. Then we'll talk about what are the things that you should be aware of before you actually decide to buy a house. We'll discuss this question whether buying an investment property in Silicon Valley makes sense or not, and what are the circumstances that it does or it doesn't. We'll talk about selecting a real estate team and how important it is for your success. And I'll mention our recommendation. With that in mind, a little bit of the background. So again, my name is Avi Urban. I'm doing real estate professionally since 2005. With me, we have today on the call Nati Natman, who is focused on investment, and he will be able to answer you some questions as well. Labarak, who is currently not available with us. She's actually traveling. She's more focused on the Silicon Valley residential side. Amit Urban, who is my son, who actually I'm using his Zoom account. He mostly focuses on commercial real estate, and he's an advisor in that category. My wife and I arrived to Silicon Valley back in 1985, and we have been active investors since 1985, investing in many different locations. The reds that you see here and here, these are investments that I actually lost money. And these are investment. Both of them are investment that until that time, I always invested with almost 100% control. Toward my later years, I tried to another methodology of basically investment with groups, and that's where you actually put the money, but you lose control. And in both cases, the experiment did not pan out well. The truth is that those investments were made during the COVID time, and I'm sure everyone is aware of the devastation of the entertainment and traveling business, as well as in Austin Place. We also invested in retirement homes. The question in both cases, they were hit hard with the changing interest rate that took place over a year ago. And in both cases, in the Portland case, we 100% lost money. We lost our investment $100,000. And in the Austin case, it's not clear how much we lost or not yet, but we definitely, it's not the kind of outcome that we expected when we made the initial investment. As far as my background, I've been in high tech for almost over 20 years. Also was the founder of 3 startups. And since I've been in real estate, we have done very well, and I'm very happy with the kind of reviews that we are getting from our clients. The Urban Group, we see ourselves as holistic realtors, and basically what it means that unlike instead of being a transactional oriented realtor, we are really thinking about the whole process from empowering clients' knowledge and decision making to helping clients buy or selling their Silicon Valley homes, to helping clients manage their residential investment portfolio. And as you see, we have quite a few of them. And when we talk about helping manage them, we are consider ourselves what's called a second level property managers, that we are helping our clients manage the local property management, and we are basically always there for them to help if they have any question. And the holistic approach is basically translate to a lifelong advisor to our clients and their families on everything real estate. So we're always here to to answer question and when asked, and helping them manage their investment. So making the case for investing, and obviously that should not be a surprise to anyone that life is a challenge. And the challenges are basically represented in this kind of in this graph. Basically, this graph kind of obviously a simplification of life. It talks about the first periods in our life where mostly to those who are lucky enough to be able to have parents and circumstances to be assisted by the environment. And the second, then we have the second part, which is a working career. And since in general, most of our clients are high-tech people, I would say that in general population, the working age is roughly until 65. I will touch that reality that if you are in high tech, that's not really the case in many examples, not in all of them, of course. And obviously, the big question then becomes, how do we support through our working career time our retirement time? And the question is obviously where this money going to come from, and that's a huge question. And as I mentioned earlier, I do believe that every person who is in the work environment is a product, and particularly people in the high-tech business. And if we look at this kind of small depiction or conceptual depiction of the economic cycle with your age, and obviously cycles are going up and down and so on. And when you are in high tech, I consider that the age after 45 and on depends on the economic cycle, you are in a death zone. So the big question becomes, how in the world do you think about it in terms of, number one, making sure that you have accumulated enough funds to be able to weather that period and support your retirement, as well as some which I do recommend to clients as well. Actually, I had this conversation last Friday with a client who is about 50 years old, and basically told him that when you are kind of somewhere between 45 and 50, you have to start thinking about your second career. And obviously, that is something which is not applicable for everyone, but as someone who's been in the industry for long enough and seen long enough, I believe that has a lot of truth in it. In addition to that, even though that you might still continue to have in your be working, I do believe that you should reduce your exposure and risk as you go forward, because simply the runway is much shorter every year. It's getting shorter every year. So the big risk you should be taking when you still have a very promising long runway, basically, i.e. career, and that's where you're taking the risk and you have time to recover. While you are getting a little bit older, obviously the runway is shorter and there is not as much time to recover from mistakes that do happen, and so on. So that is the concept that I believed in, and I hope or believe that other people believe in that as well. So the question is how to retire comfortably, and obviously, kind of a little bit of, again, simplistic way of looking at it. Rule of thumb is to multiply your desired gross yearly income in today's dollar by 20 to determine the approximate asset base. And of course, there are different asset base you will need to retire. And if we look at it again in number ways, so if you're thinking that in today's dollar you'll be able to retire with $100,000 a year, you will need at the time of retirement $2 million and $4 million and $6 million. Obviously, depends on your lifestyle. And obviously, with that, there are risks associated with any investment and the returns, the inflation, and so on. So all those things are, I'm sure, to many of you, not news, but to some maybe. When you are young, and I can include myself, when I was young, I always thought I'm invincible and there is nothing that's going to stop me and the future is ahead of me until you reach a little bit older years and you start realizing that as much as you are full of energy and talented and so on, there is some sort of a runway is getting a little bit closer. So I'm a big optimist. It's not that I'm trying to be a pessimist in any way. I just believe that you have to be realistic about the nature of the beast, particularly if you are in high tech. So diversify your investment. Obviously, the allocation plan depends on many different factors and whatever fits you. But in general, the categories are cash, obviously, that today you can earn about 5%. That's a kind of relatively high rate. Stock portfolio, very volatile many times and sophisticated. Bonds and bond portfolio, also sophisticated. And real estate. Real estate, it's also complex, and there is different product types like there are in the different other asset class. But as everything else, you always need to know what you're doing. And I personally, I would say that 60 plus of our net value is in real estate. And my wife and I started in a very early age, or when we arrived in Silicon Valley in 1985, and that worked for us very well. And we are kind of semi-retired these days, and we are enjoying the fruit of the many years of investing in real estate. And that is actually what I would like to talk to you. So in general, as the highlight is showing, investing is a long-term, lifelong endeavor, and you should think about it this way. I don't believe in the get rich quick. I believe in get rich slow. Take your time, don't jump, be careful. There are plenty of crooks all over the place, and just make sure that you're doing your homework carefully and diligently. So real estate as an asset class. So to understand real estate, we need to understand what are the factors that are impacting the real estate in general. So what I'm showing here is a Case-Shiller chart that started from the late 1800s, okay, and all the way to the mid 2010 roughly. I'll show you in a second the rest of the time. But what we see here, that there are four factors that are impacting what's called the home price index. The home price index is impacted, adjusted for inflation, by interest rate, population, and building costs. Three factors, not four. So, and we'll see that. So before we move forward, let's see where, obviously this was the financial crisis, and this is where that financial crisis was. We had a big correction here, and obviously we had the recession of 2007, 2000, and almost across the United States, 2012, and some recovery, again, another recovery. We have a rise before here is the rise before the COVID. This is the COVID period. And again, we see something, an increase, okay? So what are the factors? So interest rate. Obviously, interest rate is basically impacting real estate. And what we see here, that historically, interest rate is fluctuating, and we see here back in the mid 1980s, we see interest rate that close to 19%. Okay, and ever since it went down. Okay, the financial crisis of 2007, basically, and the recession that followed the financial crisis here, we saw interest rate going down quite dramatically and staying roughly in this age this time. Then we saw another correction here. Was the COVID time, and right now where we are as of January, the 30-year fix is about 6%, 6 to 7%, and the 15-year fix is about 6% plus minus. So what we also see that affordability, which is the key of people being able to buy a house, is also fluctuates, and we see that again threshold normalization, where we have here houses are very affordable here. Anytime we see in green, and right now where we are here. So let's see what are the factors that actually are impacting affordability. Okay, homeownership affordability. Okay, and what we see, the affordability is made of three components: income, okay, affordability in black, for income change, interest rate, and price change. Okay, and what we see that over time, the factors that are impacting affordability are changing based on different criteria. And we are right now in a period here that we see interest rate is the most significant factor adversely impacting people's affordability. Then we have price change, while the income has basically not risen so fast. If we look at here, this area, interest is still a factor, but the income was significant enough and prices were not that dramatic here, so the affordability was relatively higher. Okay, so that's the impact of affordability, and we are looking now at obviously the impact of interest. That's the component that we're looking at. Population is basically the demand side, and what is very important in the United States, you see the chart basically is going up. Okay, and what we see here that that as the population grows, it's kind of steady over many years. And by the way, the United States is one of the few Western countries that are enjoying a positive population growth. I'm sure you heard about issues of population growth in Japan, Europe, Germany, Italy, and France, and so on. And as a result, those countries resorting to immigration, and a lot of that immigration is coming from the Middle East, and there's a lot of pushback now in those countries about immigrants coming from the Middle East and what its impact it has on the country itself. Nevertheless, though, so let's see on the population. So what we see, again, that is from the government chart, we see a very steady population growth over the years, and then we compare it to home ownership. And that's very important data to look at, because here, during that period, we see that population growth and home ownership kind of was going hand in hand, okay, before the 1980s. But then it dropped, and during the 95, we see an attempt to raise the ownership. And that was a period where Clinton and then George W. Bush basically tried to raise the home ownership rate from about 64, 65%, and basically this is the time where just before we went to the financial crisis, where we've seen almost the highest ever population ownership growth in the United States, basically, and then a sharp drop after the financial crisis and some recovery. But in general, you should figure out that the general population growth or ownership in the United States is hovering around 65%. which means that there is about 35 million people in the United States that are renters. And this is your market, okay? 35 million in obviously 50 states who are your target market. And that is a very substantial number. So that's the demand side of real estate. That's the .com. Okay, we see the .com here, the Q7 meltdown, financial crisis, and COVID. Okay, and these are the periods that we've seen that. As far as building costs, obviously we see that building costs also fluctuate over time. Okay, and now let's see what's happening in building costs. Obviously, we see that building costs, we are mostly focused on residential, the red line, and we see that building costs is going up as well. And what we see here that it actually, particularly, I was doing some construction during the COVID time, and I'm sure because many of you remember that during the COVID days, supply chain issues, lumber cost, steel cost, concrete, everything went through the roof. So definitely that was a huge increase in construction costs. And when we talk about construction costs, we talk obviously about the material, labor, cost of land, and so on. So that's basically a factor that is impacting the population. So given all that, these are the factors that are impacting real estate. So let's see what's happening to long-term price fluctuation in real estate. The blue bars are prices in California. The red is the US average. The green is the S&P 500. And I always like to compare the real estate to the stock market because a lot of people that we're dealing with are kind of sophisticated people. They believe in diversification. They put their money in different asset class. So one thing which we see very clearly that there are obviously times where prices are going up and prices are going down. By the way, one of the reasons for the financial crisis, the assumption on Wall Street was that until this time, 2006, 2007, never in the history of the United States, U.S. average pricing was negative, okay? Obviously, they were a rude awakening with the financial crisis when you basically lose control and getting too wild with investment and the creative investment that took place during the post .com crash. And what we see that California had here a negative appreciation time, financial crisis time, and this is the COVID time. So clearly there are times where you will lose money, and here we lost money in California. And just for comparison, the loss in median price in California was about 37.8, but in the stock market it was about 38.49. Okay. Obviously, if you were a buyer during this time and you had to be a seller here, you would lose money. Or if you were a buyer at this time and you had to be a seller here, you would lose money. But since we believe in the long-term buy and hold strategy, and we are not speculative, most of our assets are buy and hold personally as well as our client. So if you look at the long-term averages, for instance, the US average is about 5.78, California average is about 7.44, and the S&P average of 50 years is about 8.6. So intuitively, you would say, why don't is probably the investing in the stock market is the best investment because it has the highest long-term average. It's to some people, it is true. Nevertheless, though, when I will talk about the differences and why asset class, real estate as an asset class has a very promising return, you will see why I believe, and it's not a question of belief, it's actually a question of fact, why real estate is a very good investment if you look at all the factors that are impacting your investment. So the asset class that we are discussing in general is asset single-family residence, single-family, detached, condominium, and townhomes. I like this asset class the most, and I will talk about its benefit compared to other asset class. Condominium and townhomes, it's also in the category of residential. There are a little bit issue with condominium and townhomes. Some of them are appreciation issue, depends on location. Some of them are control issues. Some of them are HOA restrictions and so on, which many times do not exist in a single family home. Then there's the multifamily up to 4. Fifth and above is considered commercial, and it has its other implication. Most of our focus is in this area. DST, it's a Delaware Statutory Trust, and that is a real estate product that is typically invested with groups and big projects. For instance, like the Austin investment that we made, that was a multi-million-dollar senior living project. Other real estate asset type that, and you see that in italic and gray, is which we do not invest, is the commercial one, residential multi-unit, land, REIT and DST. These are definitely real estate asset class, but we do not decided not to focus on this asset class. And in those commercial type, the value is derived strictly from tangible financial metrics like cap rate, gross rate multiplier, internal rate of return, and cash flow, and so on. This is an asset class which, as I mentioned, we do not involve in. As a quick analysis or comparison between commercial and real estate, and yes, there's a lot of data here. I'm not going to go over each one of them, but there are different criteria to evaluate them. And I would just say that my personal experience, I was burned out. I was burned by my investment by losing control here. Okay. And to me, I always kind of like to say that I prefer the headache of control than basically giving it to someone else and losing control and basically losing your investment, as I experienced personally. So, and I know a lot of other stories, a lot of other friends who made investment in shopping centers all over the country, and most of those investments did not turn out well. So, as a rule of thumb to myself, I prefer the headache and control rather than no headache and no money. So that's where I am personally, and that's why I do recommend in general. So what are the asset class that we are sweet spot? And this is a very good quote that I'm putting it here on the screen that I would like to share with you. Why a lot of people, and you will see a lot of investors also believe in this asset class as a single family home. This is an asset class that has proven to appreciate in general very fast. It's a product that your target clients are typically owner-occupied or future investors. It's a product, depends on the market and price point and all those kind of disclaimer that in general sells very quickly. It has an emotional component to that, which is basically is not subject to the cap rate, the GRM, and all that's very strict. It's a much more fluid analysis. And the good news about it is that demand is very much there. So it's a very strong demand for this product. It's compared to other products, as I indicated, and you will have a copy of the presentation, and you can read all the full text as you wish. This is basically shows you the demand that we have. So if we look at about the home ownership, which is in red, as we talked earlier, it reached 70% and dropped dramatically. Obviously, what we see, if you see the number of rental property, it's always a reverse function of home ownership. The more home ownership, the less rental property. And what we've seen here is a return, and here also a return. So we have a substantial number of properties that need to be added to the inventory because the US population is growing. And what we see here, these are investment market share. So what we see here, that in every market there are multi-tier. There's a low tier, mid price, and high price. And obviously every market has a different absolute dollar value for each one of those tiers. And what we see here is that typically the low price is basically very popular. Our sweet spot is the mid price, and the reason we are focusing on the mid price in general is because obviously the kind of return that you're getting is very important. But for us as remote investors, return is very important, and we'll touch the criteria a little bit down the road. But also investing in neighborhoods that you know would not create issues, particularly if you go to neighborhoods which are low income neighborhood, you're probably going to get very nice return, but you will constantly have issues with tenants paying damages and so on. Not that we do not experience those issues even in the mid range of the markets, but much less than in other market segments. And the share of investment purchases, you see that the single family resident is by far the most popular asset type, particularly for small size for investors like ourselves, focusing on single family home versus co-op and townhomes and multifamily. These are different asset class, and you see substantial difference. And why investor, as I mentioned, particularly the mom and pop investor like ourselves, while focusing on single family home. And what we see that those being such a popular investment, we have in this market how much of the share of the home purchase in different neighborhoods is purchased by investors. Particularly today when interest rates are so high, you see a very large number of investors are going in because a lot of the typical owner-occupied people cannot afford those interest rates. And many of you on these presentations who live in Silicon Valley are accustomed to, down payment of 25, 20%, 25%, and so on. In the area where we are buying, in the 8 different locations where we are buying, the typical owner-occupied would probably put somewhere between 3 to 10% down payment. So with those kind of interest rate, being able to make the monthly payment is not a trivial thing. So that's why you see a very large portion of some markets are basically participation by an investor, okay? As you see, and in addition to that, they are focusing on single-family home, but they're also focusing on the South and the West, and we'll touch that in a second. Financial benefit. So let's try to understand what are the financial benefits of owning real estate. So before we dive into the details, I want to distinguish between what's called a home and a house, okay? A home and a house. What is a home? A home is where you and your family live, okay? So your family, town, and so on. And decision is primarily made influenced by intangible, emotional, location, school, and so on. And financial consideration, price, down payment, affordability, okay? That's definitely how you look at homes. Investment house is where other people live. Basically, it's an investment property. And also in our category, a single family, townhome, and condominium, That's where we are. That's where we are. The market that we're in, and the decision is primarily influenced by tangible consideration, ROI, price down payment, cash flow, depreciation, taxes, and so on and so forth. That's the criteria. Okay. So when we talk about a financial benefit, let's look at the different aspect of it. First of all, that's the OPM, the other people money, which is basically leverage, someone else money by borrowing a mortgage. Okay, and now number one, and compound the returns. Okay, the future value is equal to the purchase price, or 1 plus R, basically appreciation in the power of the number of years you hold it. Obviously, when R is positive, you have appreciation. When R is negative, you have depreciation. Okay, and obviously, when you have leverage, that's multiplied by the leverage. Hedge against inflation. As a homeowner, you have two ways, and as a renter, as a investment property, there are three ways of hedge against inflation. The two ways that as a homeowner you have hedge against inflation is number one, that typically most of the buyers are taking mortgages which are fixed mortgages, and even if whether it's a 50 years mortgage or it's right now very popular 7-1 or 5-1 mortgages because anticipation of rate to come down, then even in the long-term U.S. average inflation is somewhere between 2 to 3%. So even if you're taking a 5 years or 7 years or 10 years ARM, every year your debt is going down by 2 to 3% because in real money. Number one, and also something which I forgot actually to mention earlier in the Case-Shiller chart, that the U.S. average of price appreciation is about 2 to 3%. We showed that on the other graph where we compare the California U.S. and the stock market. So the U.S. is about 5% on average, according to the 54 years, and California is almost 7.8%. So these are the two hedges in home ownership. When we talk about the third one is the rent. Okay, and as you can see, what we see here is the CPI of rent in blue is always tracking inflation. So we basically have three ways benefit from inflation when we are investing versus when we are owner occupied. Obviously, payoff principal for saving, the owner and the tenant, and there are many tax benefits. Okay, what are the tax benefits for homeowners? Deduct interest up to a loan of $750 and property taxes up to $10,000. You have a tax benefit of capital gain IRC 121 when you're selling your home, and you can do in California Prop. This is the U.S. and this is California Prop 19, which you can transfer your tax base without paying capital gains on it. And there is this super tax saver, which allows you to do a combo of the IRC 121 plus an exchange plus Prop 19, which is this Prop 19 is only for California, as I mentioned. This is for all US, and this is all for all USA. Okay, so when we talk about investment properties, what we see here that unlike in owner occupied, where these are the two things you can deduct on your taxes. When you are in rental properties, you can deduct all your expenses, including depreciate your improvement, which basically, when you buy in real estate in general, from a tax purposes, has two components. It has the land value and it has the improvement value. And improvement is basically the building itself, all the costs associated with building the property. And in general, for residential properties, you can basically deduct the improvement value over a period of 27.5 years, which roughly comes to, for every $100,000, to about $3,000 a year, roughly. So basically, the nice thing about that is that that's a paper loss. Okay, it's not an actual expense. It's not actual expense like paying taxes, paying maintenance, and so on, which is real expensive. These are not real. These are only paper loss. Okay, and in general, if you have, ideally, sort of, if you don't need the money, you can basically, if you put it and you want to put enough down payment to be able to create enough depreciation which equal to your positive cash flow, you would not be paying any taxes at all on this income, and defer all capital gain taxes. And I will show you what I have done in terms of our exchanges. And we have sold multiple investment property and we didn't pay a dime in taxes. Show you a little bit later. Monthly income for life ownership and in deducting of expenses. So as I mentioned, my wife and I are semi-retired, and one of the major source of income for us on a regular monthly basis is the income that we are receiving from our rental properties. And that is a very decent income that makes our life very, very comfortable and allow us to live the quality of life that we worked hard for when we worked all those years. So use this as source of for kids, helping kids, college, parent support, retirement, and so on. So these are the financial benefit of owning real estate as an owner, occupied, as well as the rental properties. And in addition to that, there is the building of wealth. And if we look at what's the most popular product for Americans, it is real estate. 35% of Americans see their real estate as as the best choice for best long-term investment. Okay, that's real estate. Stock basically is this one, and we have this is as savings, and gold is the least at this time. And one thing which is very important, we talked about leverage. So 78% of all home buyers use mortgage to buy a home. Okay, and median down payment for all homes buyers is 15%, which basically implied a leverage of 6.7. So in other words, for every percent that homes are going up, you're making 6.7%. Also, very important to remember, as I mentioned earlier, that when the rate of appreciation is positive, that is correct. When the rate of return is negative, so for every percent it goes down, you're losing 6.7% with this average example, okay? And obviously there are multiple tax benefits, okay, as I mentioned before. So when we look at this share, and again, I always like to compare it to the stock market, okay? And because that's an asset class that, particularly in our neck of the wood, it's very popular. So what we see in general in America, in the United States, that about 60% of adults are investment either directly or indirectly in the stock market through their 401k, retirement plan, and so on. But something which is very interesting, though, is how many basically people who are investing in the stock market are trading option, which basically is leverage. Option is leverage, and there are other forms of leverage in the stock market, but this is one of them. And as you see, the majority of people are not using. Okay, so other 55%, almost 56%, no, and another 18% occasionally, and only a very small number, maybe 18% of people who are in the stock market are doing options. So in other words, majority of people who are buying real estate have a leverage, and the majority of people who are investing in the stock market are not using leverage, which basically means that they are not benefit from the leverage that is being offered. And the reason may vary, but this is the fact. So what is our investment strategy? Okay, our investment strategy. So establish a real estate investment portfolio. and that's our objective, and so on. Generate passive income for retirement. So we are basically not necessarily are looking to generate income for today, okay? We are looking, our focus is long-term, generate passive income for retirement. That is our focus. Build wealth and legacy through appreciation over the many years, okay? And minimum hassle and risk. So what that basically means that being in most cases and all the over 450 homes that we are managing as a second level property management, we are remote. We are not in those areas. We invest in 8 different locations from California, Las Vegas, Arizona, New Mexico, Tennessee, Atlanta, and different neighborhoods and so on. And we're not there. And so we do have a job. Most of our clients have the jobs. Okay. They don't want the real estate portfolio to become a major time consumer for them. So by actually helping them on one hand, but also making sure that we're investing in properties where our long-term average are positive in terms of hassle and risk, that is our philosophy, okay? This is our focus, is always not to turn your investment into a nightmare, which many people are experiencing in different markets. So the whole concept of portfolio is very important to us. Meaning, don't look at your entire holding, and not we are advocating the notion of buying multiple properties and thinking about it as a portfolio. And what we talk about in general is your total return on investment is equal to cumulative cash flow plus appreciation plus strategic improvement. What I mean by strategic improvement is in areas where the cost of the land is very high, like California, where the cost of the land in Silicon Valley, like the cost of the land is typically between 50 and 60 or 70% of the cost of transaction. Strategic improvement means that you add square footage to the house, you build second floor, you build ADU, you expand the house, you remodel it, and so on. And that's basically build value because you already paid for the land, but when you sell the house, you basically get back based on the square footage of that you already have put into the house. So if construction in Silicon Valley can vary between $300 and $500 a square foot, and typically in the market, the homes are going over $1,000 square foot construction build, then you instantly tripling or more your investment by adding more square footage, improvement, and so on and so forth. That is what I refer to as strategic improvement. In the area outside of Silicon Valley where we invest, typically the distribution between improvement and land is about 20%, 80% to 20% land. Land is very relatively cheap in those places, between 20 to 30%, and the rest is basically the cost of construction and so on and so forth. So typically, when areas where we have good cash flow, the appreciation is not very high. With the caveat, I would say that during COVID, actually, historically, that Silicon Valley had a very high appreciation. During COVID time, appreciation in other places like Arizona, Tennessee, Atlanta, and so on was higher in percentage than in Silicon Valley. Areas where appreciation is high, the cash flow is not very high. For instance, here in California, you buy a home in Silicon Valley, we're roughly with the area where I live. Typical home is about $2.5 to $3 million, and you probably can get about 6,000 to 7,000 plus minus rent. So there's a huge disparity between the returns on the rent versus the cost of the property. So, so again, talking about the concept of portfolio investing over time, where you buy over every time, whether it's 1 year, 2 years, 5 years, whatever works for you, multiple properties to build your portfolio. And we see kind of two categories of markets or homes that we're looking at. Area of growth property, growth market, and basically in the growth market, and that is maybe like Silicon Valley area, like Arizona had long-term appreciation. By the way, Texas, okay, Texas for the longest time had very, very subprime or subpar appreciation compared to other places in the United States. Recently, in the last, I would say, maybe 5 years plus, we have seen some appreciation, particularly where we've seen migration from Silicon Valley and to areas like Austin and other places where we had a faster appreciation. So growth area and value area is not necessarily cast in concrete, but there are definitely areas that has a long-term averages which are higher than others. So we are advocating the concept of you are buying properties every certain time that works for you, and you diversify between cash flow focus to value focus, which is mostly cash flow focused, and growth is mostly appreciation focused. And I'm dividing the concept to two kind of a period in our life, okay? The equity focus, when you still have a full-time job and you are not concerned about having another few $1,000 a month to be able to spend, but you mostly focus on building your equity, okay, for retirement, for your saving. And cash flow focus is where I am in my life right now, semi-retired, and I have accumulated enough equity, and I'm now in a phase of my life that I want to slow down in working and commit more of my remaining time to enjoy life and the fruit of our labor. And yes, we want to leave to our children some obviously legacy to them and to our grandkids. But our focus is also about enjoying the time that we have left and benefit from the fruit of our work. So that is the kind of philosophy that we are subscribing and also sharing with our clients. So before you going to make an investment property, what are the criteria that you have to consider before you jump into that water? Okay, so I divided into different categories, and in each categories we have some issues that we have to consider. Okay, and obviously the population and job growth, what type of jobs, historical projection, major industry, these are all impacting the local economy and the future performance of your assets. Real estate market, prices, affordability, taxes, and so on. For instance, if I'll touch the property taxes and insurance, these are very hot issue these days. We have seen a lot of appreciation in the South and West. The other states do not have Prop 13 that we have here in California, which limit the price, the property tax increase, and we have seen substantial tax increases in area like Arizona, Texas, Atlanta, and so on. And the other element is insurance. I'm sure you heard that in areas like Florida, Louisiana, New Jersey, insurance have jumped significantly. And a lot of insurance companies are bailing out of those areas. And insurance today, if you can get it, is very, very expensive. So all those things that you have to take into account. Obviously, location, demographics, owner-renter ratio, environmental. Environmental is again relating to this insurance impact of either fire that we experience in California, flooding, hurricane that we see in the East Coast in Florida, Louisiana, all those areas. These are all the areas that you should think about it very carefully. And as also the property type, single family, and so on and so forth. So these are the criteria that when you are thinking about buying a real estate, you should be focused on, okay, and inquire about it. So have a feeling for what's going on before you jump in. So as far as the most important factor is obviously population growth. This is where your renters are coming from. This is our focus, concentrated in. This is where your sellers or buyers are coming, are there. So the U.S. is basically divided into 13 mega regions where you see a huge concentration of population. Basically, most of the United States, as you know, is open land, okay? But the high concentration of population are in those different areas. And the United States is divided into census region, basically West, Midwest, South, and Midwest. And obviously, we have also the territories of Alaska, Hawaii, and other territories. Obviously, Alaska and Hawaii are not territories, are state, but we have other U.S. territories as well. And the population projection for 2040 compared to where we are today at about 336 million as of February this year. And what we see, U.S. projection of 2040 is about 379 million people, additional 40 million people. Mainland population distribution by region is the following. So this is where our population will be focusing, and that's the area where the demand will be there. And obviously demand exists because the economy attracts people to those areas and so on. So these are the areas where we are seeing population growth, okay? And another thing which is of interest is average number of people per household. So roughly we are running an average of about 2.6, roughly 2.6 in the United States, which basically means that we're going to need about 15.5 million new homes, and that will be about 5.7 million rental units, new 5.7 rental units on top of what's currently on the market. Okay, again, this is the available market that we have and the future growth of this rental market. Some examples of properties that we have bought, and yes, we go all the way back to 2010, basically the financial crisis. This is a house that we bought, 1,500 square feet house. This is the improvement, and this is the lot size. REO, real estate owned, basically was a post foreclosure purchase, which we bought for $100,000, and the purchase price was $100,000, but the insurance required us to insure the house for $200,000. So basically, that was a phenomena which was existed for a short time, which every home you bought had built-in intrinsic value, basically due to the financial crisis and the hundreds of properties that were dumped to the market. And I'm sure you remember the movie The Big Short, and all the lessons that could have been learned there. We bought quite a few properties. I wish we have bought more, obviously hindsight. But nevertheless, though, that's as far as the rent is. And per Redfin is actually 383. That is the current value of this house. This is another house that we bought also in 2012 for $117,000, and it was just sold literally last month for $310,000. Okay, this is another house which we recently bought in Tennessee, 21, for about $236,000. Prices have went significantly since then. We are basically monthly rent of about $14.50. Again, the rent went up substantially. Annual repairs. These are some of the kind of financial that we're going to go in more detail if we move forward with you guys. And the kind of return that we can have, what's projected return, cap rate, cash on cash, basically, and the kind of analysis that we are doing for every purchase we do. And when we are sending investment opportunity out there, it's like almost 10 pages of analysis of the properties, financial areas, and so on that will share with those who want to move forward with investing and inquiring about it. This is an example of East Menlo Park, the property that my wife and I personally bought in 2018 in East Menlo Park. It's a 2.5 Bass was today 1,200 square feet, and again a lot of 5,750. And this is where I was talking about the strategic opportunity, strategic improvement opportunity. It's a 1,200 square feet home on a almost 6,000 square foot lot. I can double the property size, if not more, plus an ADU, and not pay additional dime on the on the land, and basically get my investment double or triple my investment. The garage 200 square feet, purchased for 1.25, remodel for 250. It currently rented for almost $5,000. Again, today let's assume that the what is this? The let's see, the Zillow value is almost 1.3. So it currently it on the appreciation side, it's not a great investment. And obviously, one of the reasons for that is the fact that we had COVID, and this is next to Facebook, Stanford, Google, and so on. And because of COVID in the last almost three plus years, almost 4 years, we basically had to work from home, and a lot of people didn't have the need to be close to work. And so today the things are changing a little bit, and I believe that that area will appreciate in the future. Number one. Number two is one of the few areas in Silicon Valley where the ratios are still good. So let's assume it's a $1.3 million home, and we're getting almost $5,000 of rent. Let's say in Silicon Valley, the area that I live roughly, you will probably, the homes are roughly $2.5 million to $3 million. And I will, in terms of rent, I will be able to get $6,500, $7,000. So the price is almost double what this is, but the rent is not, okay? So that is still, there are a few areas in Silicon Valley where from a ratio perspective, it makes sense to invest. And East Menlo Park is one of them. And I do believe in the long term of this area, since it's very centrally located. It is, as I mentioned, downtown Palo Alto, downtown Menlo Park, Google, Facebook, Stanford, all this work hub. This is an example of some of our properties, investment properties that we bought for our client over the last year. And what we see here, prices are basically in the $220,000 price range. In the beginning of the year with projected rent of $450, but actual was $1,895. And as we move down the road, we've seen the time of the year and the homes and so on, and the location, we see prices are going up. Today, the prices that we are looking at mostly in some areas is somewhere between $280,000 to $350,000 of so $280,000 plus minus to $350 plus minus, with rough rent of about $1,900 to $2,300 a month. This is kind of the range of prices that we see in our rental property recently, which we're looking at. Lever and exchange. This is an example where my wife and I have done in one of our investments in Silicon Valley. So this is a house that we bought in Santa Clara. This was our first owner-occupied home in Silicon Valley, which we bought in 1987 for $175,000. We sold it in 2004 for $595, and at the time when we sold it, we had it was a rental property, because what happened, we lived there for about 10 years, and then we moved to Sunnyvale, and we hold the property for another 10 years as a rental property. Okay, and at the time we sold it, we rented that for $1,800 a month. We sold it in 2004, and we exchanged into 6 properties. 4 we own by ourselves, and 2 we own with partners. Okay, so one concept that we have leveraged from our first purchase in Silicon Valley is working with partners. And that is because at those times, in 1985, the appreciation in Silicon Valley was quite significant on a yearly basis. So instead of being saved, we decided to save the down payment and income fast enough to beat appreciation, we decided to partner with friends that we trusted and buy properties together with them. And this way, we were able to accelerate or minimize the period between each purchase. So with the money that we got out of the sale of this property, we bought 4 properties ourselves, and then we bought 2 as part of it, and we managed to put $25,000 in our pocket without paying taxes on it. Then after a few years, we sold that property. We bought it for $150,000, and we sold it for $260,000, and we bought 3 properties in Tennessee. Again, we put $25,000 in our pocket, and we bought 3 properties here. A year passed, and this house we sold last year. This house we sold last year, we bought was $225,000. We sold it for almost $86,000. This house has a rent of about $26,000 a month. It has an HOA of about $100 and another pool service for $100,000. And the house were getting older, so our expenses were getting higher by the year. In addition to that, since it was a partnership, heading to retirement, we wanted to simplify our ownership so our kids would not have to deal with that and simplify it for them. So we sold that property and we bought another property in Tennessee for $300,000 with a rent of $220,000, and its current market value, it didn't change. It's just about last year, less than a year ago. So again, for us, the current fair market value of the property is not critical. Is more, we are in this phase of our life, as I mentioned, cash flow phase, where we are looking to getting the passive income so to afford our comfortable retirement. The other house we sold here, again, bought it for $130,000. A rent was $1,500. We sold it for $355,000. Okay. Again, an older house, okay. That house was bought totally with cash, okay. Totally cash, okay. No leverage here, because right now as you are aware, the interest rates are relatively high, and particularly on investment property, they are hovering around 7%. So our money in Schwab is not making 7%; they're making 5%. So why should I pay extra if I can make more on my money? So basically, and as I mentioned, also as with your age, you want to reduce your risk and exposure, and you're more focused on cash flow than appreciation. So here is a house which we bought in Georgia for $265,000, and we basically the fair market value, and in addition to the money that we received here, we actually put some money in a DST as well, okay? And actually, I forgot to mention that as well. So when you look, and this is another property that we are sold in Las Vegas. Again, the property we bought for $234,000. We sold it for $265,000. Vegas at that time, again, was not a great investment. Sold it during the COVID time. And we bought another property in Tennessee for cash also. And look at that, we bought it with partnership with my own IRA, okay? So you can do a self-directed IRA and invest in real estate as well. And basically from $1,200 a month, we're moving to, and it's a half of that amount. We moved to about $2,180, and the fair market value is actually, we also see a nice appreciation bump here. So if we look at, compare, okay, so what is the fair market value of this property today in the market? And the update was February of this year. So this property in Santa Clara is probably worth about $1.6 million today. And if I would rent it, it's probably going to be about $41 a month. So what did I manage to gain of this exercise? So the total fair market value of my property is almost $2.595 million. So my net growth grew from 4.95 versus 2.66. Okay, and my rent which is about 1575 a month, grow almost 875 compared to 2.28. So I personally view that as a very smart move that I manage. Yes, and of course there's there's more work, there's more all that stuff. But basically, these are the kind of strategies that help me get into our retirement age and benefit from our long-term investment. So this is an example. Case for investing in Silicon Valley. So what are the reasons for someone to invest in Silicon Valley? And I point those things, and you can look at that in your free time. Just want to make sure that we are going on, and you will have a copy of the investment. But there are multiple reasons to consider if you should buy an investment property in Silicon Valley. Some of them may be applicable for you, some of them are not. But there are good reasons for doing so. It just the circumstances we have to be so that it fits to you. And if you need more information, I will be happy to discuss it with you. Nevertheless, though, I always monitor the Silicon Valley, and the demise of Silicon Valley was projected many times over. And I'm here since 1985. I do remember those stories very, very well. And I typically would say that the future of Silicon Valley depends on whether the valley, unlike Detroit, will be able to always renovate and change and adapt to the new reality. And just over the last year, we see how, again, Silicon Valley was managed to capture the prime place for AI, okay? And this is what this basically, again, I'll let you read it in your free time, where successful places tend to change and continue change, be successful. And obviously they have to avoid what I would say the Detroit syndrome, where they basically did not keep up with the competition and basically lost their ability to be a leading place for an economy for many years or since. So look at that, and you can study that for yourself. Drawback of owning real estate. So again, like everything else, is it too good to be true? It is good. It's very good, but there are some issues that you should be aware of. And again, I'll post it, and we can talk about those issues. So there are drawbacks of owning real estate. There are drawbacks of owning stock. There are drawbacks for owning bonds. There are drawbacks for owning Bitcoin. You should be aware of that and make sure that you understand those and understand that this is real estate is a business decision. Every problem is solved with money 99% of the time. So it should not become an emotional drain on you, and you should be aware of that. And again, we can share with you experiences. Now we have a simple portfolio for our clients of over 450 homes. And we can tell you that we had cases where our clients had major losses of $15,000 so where a client or renter demolished the places. The good thing is that that does not happen very often. It's a very rare event. And we have a significant portfolio size to tell you that that's something which we do not experience on regularly. And I would say that in the last 10 years, maybe we had 3 cases of major damages of over $10,000. But we do experience other issues of broken refrigerator, broken air conditioning, vacancies, late payment. We do experience having to evict clients and so on. But bottom line, I say that being a landlord is not necessarily for everyone. For outside Silicon Valley, the services that we are providing is focused in 4 different areas. Okay, again, a lot of details. You will have a copy of that. You will be able to look at that. So again, that goes back to our holistic realtors. We provide a service, a turnkey service to our client. Most of our clients are busy professionals, and we are trying to simplify the process for them through the life ownership of the product, before the buy, after you buy, and while you own the property, and we are helping them through that process. In Silicon Valley, we also have different criteria. It's a little bit different, but the same concept is we take ownership and help our clients through the process, and so that they can basically continue their life. And so owning that asset class is not a major part of their life. Our added value. So what we bring to the party is, again, in different locations, in different categories, you will have all that stuff ready for you. And I would say this, that the team that you're going to decide to work with will be critical for your success. Okay. And it's very, very important that whoever you decide to work with, you do your homework, you check referrals, you interview them, you talk to past clients, and get the full scope of the service they provide you. So very, very important. The reason I actually show that this is obviously an iceberg, and obviously the final objective is to find you a property, okay, which is basically the 10% of the effort. The 90% of the effort that associated with finding you the right property at the right time, at the right price, in the right neighborhood, with the right people, with the right partner, the right condition, is the major work that we are doing for you, and might not even be visible initially. And that's why we are educating on what we are providing you as part of our service. Our recommendation, you should start investing in real estate if you define your long-term investment objective and strategy. You should define it to yourself and make sure you understand what are the reason and what are your objective. Okay, you are comfortable becoming a landlord. As I mentioned, a landlord is not for everyone. I would tell you, as someone who owns multiple properties, that in general, it doesn't take me more than 10 minutes a month to manage properties. But there are times where it takes me an hour a month or more. If the renter is not paying, there are issues, there are problems, but most typically it's not a major time sink. And the nice thing about it, unlike your job, is nobody can fire you and nobody can outsource you and so on. So these are one of the benefits that I find very attractive. You're relatively confident with your job security because right now we're talking about your period in your life where you are focused on building your equity. So you want to make sure that you have a stable job to be able to make investment and obviously continue maintaining your lifestyle and support the family. You have the down payment and reserve, and you definitely need reserve because there will be time where you're going to need to replace the roof, replace the air conditioning, the tenant will be not paying, and so on. So you have to have cushions to be able to weather those periods of time where things are not as ideal as they should. You have pre-approval from a reputable lender if you are going through mortgages. You have a research the target market you want to invest and have a conclusion. You are monitoring the target market that you want to be inside and look at different opportunities. You identify a real estate team that you trust and you believe that you will be able to work with. And again, as I mentioned, make sure that you are doing your homework and check references and make sure that what they advertise is what they really is the story. You believe in a better tomorrow. Obviously, it's all based on the fact that the world will not collapse, that the economy will continue to be on average positive, people will be able to pay their rent and so on. So that's obviously a prerequisite for making long-term investment. As I mentioned earlier, investing is a lifelong endeavor, and that's how you should be looking at it as a long-term uh, endeavor investment. And that's something that required thinking. And once you understand that, it can be very rewarding. We, in addition to doing investment properties, we're helping our clients in Silicon Valley buy their home and develop their investment portfolio. As far as the next step, schedule a follow-up meeting to discuss your needs, wants, and so on. Get a pre-approval from a reputable lender. Agree to exclusive representation, which we only work on this basis, and start searching your investment property. And to receive the recorded, okay, send me your email. And thank you very much for your time.